The vision of the American dream centered around upscale living is beginning to crumble right before our eyes. By 2026, the premium housing sector, historically considered protected from economic downturns, is disintegrating far more rapidly and dramatically than most observers ever anticipated. Metropolitan areas that previously displayed multi-million-dollar properties, where competitive offers erupted instantly, are now saturated with price slashes, desperate homeowners, and enormous residences remaining vacant and untouched. This isn't concerning modest residences or initial property purchasers. We're examining elite properties featuring infinity pools, marble-wrapped kitchens, exclusive rooftop spaces, and 6-vehicle garages. These were the residences that represented achievement and prestige. Now, many of them are remaining listed, reduced by hundreds of thousands and, in certain instances, millions of dollars. This extends well beyond a standard market adjustment. What's occurring is a comprehensive breakdown in the premium housing category. Before we count down the 10 cities where high-end property valuations are declining the fastest, subscribe to Stable World for data-driven breakdowns of housing market transformations reshaping America. Be sure to watch all the way through because the number one city is losing wealth at a velocity not witnessed since the 2008 financial meltdown. Hit that like button if you want real analysis that goes beyond surface-level headlines. And if you haven't subscribed yet, now's the moment because this luxury collapse is just the opening act in a much larger housing transformation, and we'll be analyzing every development as it happens. Number 10. Dallas, Texas. Dallas was historically regarded as the premier destination of Texas premium real estate. Upscale residences in communities like Highland Park, Preston Hollow, and Turtle Creek consistently transacted for anywhere between $2 and $5 million, frequently acquired before they ever surfaced on the MLS. But by 2026, that brilliance has diminished rapidly. At the market's pinnacle in 2022, the median valuation for luxury properties, classified here as the top 10% of residences, exceeded $1.3 million. Currently, those identical properties are exchanging hands closer to $1.05 million. That's approximately a 20% decline in just 3 years. For residences valued above $3 million, price reductions of $500,000 to a complete million are no longer startling. They're becoming standard. The primary catalysts are oversupply and escalating ownership expenses. Throughout the pandemic, Dallas witnessed a construction explosion, with developers flooding McMansions and premium condominiums into the market. Now, the consequence is surplus inventory. Residences priced above $1 million are sitting at nearly 10 months of supply, roughly double what's regarded as a balanced market. Listings that previously vanished within days are now remaining on Zillow for 120, sometimes even 180 days. Assessments add another dimension of pressure. Property assessment rates in Dallas County hover around 2.2%, which means a $2 million residence can generate an annual assessment bill near $45,000. Beyond that, insurance rates have skyrocketed, frequently exceeding $12,000 per year due to Texas hail damage and severe weather dangers. Combined, these costs are pushing monthly carrying expenses to thresholds that challenge even high-income purchasers. Investors aren't discovering relief in rentals either. Premium rentals in Dallas typically generate about $6,000 per month, while total ownership expenses often surpass $10,000. What was previously marketed as a cash flow opportunity has transformed into a quiet exit plan, with investors liquidating properties, many at substantial losses. Foreclosures, once nearly unprecedented in Dallas's premium market, are now creeping upward. Dallas and Tarrant counties have documented a 14% increase in high-end foreclosure filings compared to last year. Dallas may still project an appearance of prosperity and achievement, but the fractures are appearing. For luxury purchasers, the concept of Dallas as a guaranteed secure investment is gone. The city is rapidly becoming a case study in how a booming Texas market can transition into a collapse with alarming velocity. Number 9. Miami, Florida. Miami has historically been regarded as America's premium destination. Penthouse panoramas over Biscayne Bay, waterfront properties in Coral Gables, and sleek glass structures lining Brickell Avenue. But by 2026, Miami's high-end housing sector is confronting its most serious crisis since the 2008 financial breakdown. From 2020 through 2022, Miami evolved into a global destination for wealth. High-income purchasers from New York seeking to escape assessments, Californians attracted by sunshine, and international investors from nations like Brazil, Argentina, and Russia channeled billions into South Florida real estate. Valuations exploded. A premium condominium on Brickell that transacted for $1.5 million in 2019 was resold for $2.4 million just 3 years afterward. Waterfront properties in Miami Beach doubled in valuation within 5 years. That momentum has now reversed. Currently, average valuations for Miami premium condominiums are down nearly 22% from their peak. Properties that previously ignited competitive offers are sitting idle. A condominium that previously transacted easily at $2 million now struggles to move at $1.55 million. Waterfront residences originally listed at $5 million are cutting valuations by $1 million or more and still remaining listed for months. The explanations are evident: excessive supply and persistent ownership expenses. Between 2018 and 2024, more than 20,000 new premium condominium units entered the Miami market, and demand simply hasn't maintained pace. Simultaneously, Florida's insurance catastrophe has transformed premium ownership into a financial burden. Insurance rates that once operated around $15,000 per year for waterfront residences now consistently exceed $40,000. HOA charges have also surged. Monthly payments of $1,500 are now standard in premium towers, and certain buildings charge more than $2,500 per month. Investors who previously relied on Airbnb revenue are withdrawing as well. Occupancy percentages in Miami have slipped below 55%, while nightly rental rates have fallen roughly 20%. Wealthy international purchasers, once the foundation of Miami's premium market, are retreating, unsettled by high U.S. interest rates and broader global uncertainty. The consequence is a growing number of vacant towers and sellers increasingly desperate to liquidate properties. The Miami premium vision, sunshine, skyline, and ocean panoramas hasn't disappeared, but the market constructed around it has become overextended, and the aspiration is now collapsing under its own mass. Number 8. Scottsdale, Arizona. Scottsdale established its standing as Arizona's premier location for premium desert living. Gated golf neighborhoods, expansive desert properties, and million-dollar condominiums positioned against Camelback Mountain became the ultimate status indicators. But by 2026, Scottsdale's premium housing sector is disintegrating rapidly, crumbling like a sand structure under stress. Premium residence valuations in the region peaked in 2022 when the median reached about $1.2 million. By mid-2026, that figure has slipped to roughly $975,000, marking a decline of about 19%. Residences valued above $3 million are witnessing routine price reductions of $500,000 or more, and many of those listings are sitting idle for months without serious attention. The fundamental problem is a collision between surplus supply and a diminishing pool of purchasers. From 2018 through 2022, developers committed fully to upscale golf community construction, saturating the market with high-end inventory. Now, Scottsdale is managing more than 9 months of supply for residences valued above $1 million. Properties that previously transacted in about 20 days are now remaining for 100 days or longer. Ownership expenses have added fuel to the decline. While property assessments are lower than in California, insurance costs have surged due to increased wildfire and flood dangers in the desert. Annual rates that once averaged around $3,000 are now pushing past $7,500. Simultaneously, mortgage rates above 7% have dramatically raised monthly obligations. A $1.5 million residence that cost roughly $6,200 per month to finance in 2021 now carries payments exceeding $9,200. The rental sector is no longer offering a safety mechanism. Premium vacation rentals in Scottsdale are oversaturated with average occupancy dipping below 50% and nightly rates down nearly 15%. Investors who previously relied on Airbnb golf retreats for steady revenue are now selling at losses. Foreclosures are beginning to surface, particularly in North Scottsdale, where families who stretch to afford $2 million properties are discovering themselves underwater. Scottsdale's appearance as a desert premium sanctuary is fading rapidly, replaced by a harsher reality. High-end living here is no longer the effortless, sustainable investment it once seemed to be. Number 7. Los Angeles, California. For decades, Los Angeles positioned at the very epicenter of America's premium real estate universe. From sprawling Beverly Hills properties to oceanfront estates in Malibu, LA represented the pinnacle of multi-million-dollar living. But by 2026, that long-standing appearance is starting to fracture. And for some homeowners, premium aspirations are transforming into foreclosure nightmares. The valuation declines are impossible to overlook. Median premium residence valuations across Los Angeles County peaked around $3.2 million in 2021. By mid-2026, that figure has fallen to roughly $2.55 million, a decline of about 21%. At the very summit of the market, ultra-premium properties valued above $10 million are being compelled to slash asking valuations by $2 to $4 million just to generate attention. Multiple forces are colliding simultaneously. Years of speculative overbuilding generated surplus supply, while rising property assessments and California's notoriously high cost of living continue to suppress demand. Mortgage rates above 7% have transformed monthly obligations on 15 to 20 million estates into staggering commitments. In wildfire-exposed regions like Malibu, annual insurance rates are now exceeding $100,000. HOA charges in gated hillside neighborhoods have surged as well, in certain cases doubling. The local purchaser pool has also thinned. Layoffs across the entertainment sector, combined with declining production activity and shifting tax incentives, have reduced the number of high-earning purchasers who previously fueled demand. Foreign investors, previously a dependable presence in Los Angeles, are retreating amid global uncertainty and tighter financial circumstances. Rental revenue isn't offering relief either. High-end rents have stalled, and stricter short-term rental regulations have severely undercut Airbnb strategies. As a consequence, foreclosures are beginning to surface in locations like Beverly Hills and Calabasas. What once seemed unimaginable is now occurring. Banks repossessing multi-million-dollar residences from owners who stretched too far. Streets that were previously lined with exotic vehicles now feature price reduction banners instead. The long-standing myth of endless wealth and unstoppable demand in Los Angeles is fracturing, revealing a harder truth underneath. Even Hollywood, it turns out, can't script its way out of a housing breakdown. Number 6. San Francisco, California. San Francisco was historically viewed as the ultimate symbol of West Coast prosperity, a location where tech founders and venture capital elites drove valuations sky high in communities like Pacific Heights and acquired premium condominiums downtown without hesitation. But by 2026, the city is experiencing a full-scale breakdown in its premium housing sector. Premium residence valuations in San Francisco peaked around $3.5 million in 2020. Currently, the median has fallen to roughly $2.75 million, marking a decline of about 22%. The circumstance is even worse in the downtown condominium market, where valuations have plunged nearly 30% from their highs. The causes are layered and widespread. Large-scale tech layoffs have sharply reduced the city's population of high-income earners. Simultaneously, remote employment has drained demand for downtown living, leaving once coveted premium towers struggling to attract purchasers. Ongoing concerns around crime and homelessness are further discouraging would-be homeowners. Cost pressures only deepen the damage. Property assessments on a $3 million residence exceed $35,000 per year, while earthquake insurance rates are now pushing past $15,000 annually. Meanwhile, inventory continues to climb. Premium condominiums that previously transacted within days are now remaining listed for more than 200 days. Developers who previously assumed tech prosperity would never slow are now scrambling to move inventory. They're offering steep incentives, covering HOA charges, throwing in high-end upgrades, and even dangling Tesla giveaways. Still, demand remains weak. Investors are stepping back as well, with premium rental valuations down nearly 18% and returns no longer calculating favorably. Foreclosures are beginning to quietly surface in San Francisco's most exclusive communities. Families who stretched to purchase $4 million residences during the peak are now underwater, watching valuations slide further. San Francisco, once considered untouchable in the premium world, has become a clear warning of how rapidly a market tied too closely to a single sector, especially tech, can unravel. Number 5. Aspen, Colorado. Aspen has historically stood as the ultimate symbol of exclusivity. Think ski chalets selling for $10 to $20 million, billionaire estates positioned deep into the mountains, and premium condominiums valued higher than properties in most major cities. But by 2026, even Aspen is no longer immune. Its premium housing sector is sliding sharply, shattering the concept that it was ever recession-resistant. High-end residence valuations in Aspen have fallen nearly 18% from their 2022 peak. A chalet that previously transacted for $12 million to a hedge fund executive is now listed closer to $9.5 million. Vacation condominiums that previously commanded $4 million are trading nearer to $3.2 million. These aren't isolated instances. They reflect a broader retreat in demand. The purchaser pool has thinned dramatically. Higher mortgage rates have pushed valuations beyond the comfort zone of even very wealthy purchasers. While the ultra-elite group of billionaires who previously dominated Aspen purchases has begun shifting attention to international locations, simultaneously, ownership expenses have exploded. Property assessments, wildfire insurance, and steep HOA charges in exclusive ski neighborhoods now add hundreds of thousands of dollars each year just to hold a property. Investor demand has taken an especially hard impact. Stricter short-term rental regulations have crushed the Airbnb calculations, with rental revenue down more than 25%. Revenue streams that previously justified 8- and 9-figure purchases no longer make sense on paper. As a consequence, premium residences are remaining listed for more than 200 days at a time. Foreclosures remain uncommon, but they are starting to appear, an alarming signal in a market once viewed as untouchable. Even in Aspen, some over-leveraged purchasers are being compelled to walk away. The illusion of Aspen as a safe sanctuary for endless prosperity has been broken. Its downturn is proof that when the calculations stop functioning, even America's most exclusive premium markets can unravel. Number 4. The Hamptons, New York. For years, the Hamptons represented the ultimate summer retreat for Manhattan's elite, a location defined by exclusivity, prestige, and seemingly endless demand. But by 2026, that appearance is starting to unravel. Premium residence valuations in the Hamptons peaked around $3.2 million in 2021. Currently, the median has slid to roughly $2.6 million, an 18% decline. At the very summit of the market, ultra-premium beachfront properties that previously carried $20 million price tags are now slashing $3 to $5 million just to attract attention. The downturn comes down to two forces colliding: oversupply and crushing expenses. Throughout the pandemic, wealthy New Yorkers rushed eastward, triggering a wave of new premium construction. Dozens of high-end residences flooded the market in a short period of time. Now, the Hamptons are sitting on nearly 12 months of inventory. Properties that previously transacted within weeks are remaining for 180 days or longer, waiting for purchasers who are no longer rushing in. Owning these estates has also become dramatically more expensive. Property assessments on an $8 million residence can exceed $120,000 per year. Insurance expenses for hurricane and flood danger have surged past $50,000 annually. When you factor in full-time staff, groundskeepers, security, housekeeping, and maintenance, the yearly carrying expenses for a premium Hamptons property can easily reach between $300,000 and $500,000. Rental revenue, once the safety mechanism, is no longer providing relief. The short-term rental sector is saturated with weekly Hamptons rates down nearly 25%. Investors who counted on renting to Wall Street executives during peak summer months are now losing capital instead. Foreclosures, once almost unheard of in the Hamptons, are beginning to surface. Banks are quietly repossessing multi-million-dollar estates, a development that would have been unthinkable just a few years ago. The Hamptons' aspiration, constructed on scarcity, status, and perpetual demand, is rapidly transforming into one of the most painful premium housing collapses on the East Coast. Number 3. Las Vegas, Nevada. Premium real estate in Las Vegas has always leaned into spectacle. Think million-dollar penthouses overlooking the Strip, oversized properties with infinity pools, and hillside estates constructed to make a statement. But by 2026, that high-gloss appearance is fracturing. The premium bubble in Las Vegas has officially burst. Premium residence valuations peaked in 2022 when the median hit about $1.1 million. Currently, that figure has fallen to roughly $880,000. a decline of around 20%. Residences valued above $2 million are being compelled to cut, asking valuations by $400,000 to $600,000. And many are still sitting unsold for months at a time. The breakdown comes down to familiar forces, excessive supply, and rising expenses. Throughout the pandemic expansion, developers saturated the market, convinced demand would never slow. Now, Las Vegas is managing nearly 11 months of inventory in the premium segment. Simultaneously, mortgage rates above 7% have sharply reduced affordability, even for high-income purchasers. Owning these properties has also become far more expensive. Property assessments on a $2 million residence now exceed $20,000 per year, while insurance expenses tied to desert flooding and wildfire danger add another $7,000 annually. Monthly ownership costs that averaged around $6,000 in 2021 are now pushing closer to $9,000. Rental revenue isn't providing a lifeline. Premium Airbnb bookings are down about 20%, and an oversaturated vacation rental sector has left many units sitting empty. Investors who previously relied on nonstop tourism demand are now rushing to offload properties. Foreclosures are beginning to rise, even in upscale neighborhoods like Summerlin and Henderson. The Las Vegas premium fantasy, constructed on glitter, glamour, and the promise of endless demand, is fading rapidly. Beneath the neon lights, financial stress is spreading, and for the first time in decades, Las Vegas isn't selling a dream. It's selling losses. Number 2. San Diego, California. San Diego was historically viewed as the quieter, more refined premium alternative to Los Angeles. Beachfront estates in La Jolla, dramatic cliffside residences in Del Mar, and high-end condominiums overlooking the harbor define a market constructed on understated prosperity. But by 2026, that appearance is breaking down, and San Diego's premium housing sector is sliding rapidly. Premium residence valuations in the region peaked around $2.4 million in 2021. Currently, the median sits closer to $1.95 million, reflecting a decline of roughly 19%. At the very summit of the market, ultra-premium properties valued above $8 million are being compelled to cut, asking valuations by $1.5 to $2 million just to attract attention. The pressure points are evident: rising expenses and growing oversupply. Property assessments alone on a $5 million La Jolla estate can exceed $55,000 per year. Insurance rates tied to wildfire and flood exposure have surged past $25,000 annually. Beyond that, mortgage rates above 7% have driven monthly obligations from roughly $12,000 in 2021 to nearly $18,000 by 2026, dramatically narrowing the purchaser pool. Inventory is also accumulating. Premium residences that previously transacted quickly are now sitting listed for 150 days or longer. Sellers are cutting valuations, offering incentives, and even including premium vehicles in transactions, but purchasers remain hesitant. Rental revenue isn't providing a fallback. Demand for high-end vacation rentals has dropped sharply, with average occupancy falling below 50%. Rents that previously comfortably covered carrying expenses are now coming up about 25% short. As a consequence, foreclosures are quietly beginning to appear in some of San Diego's most exclusive communities. Families who stretched to purchase $3 to $5 million estates during the expansion are now stuck, watching their equity evaporate as valuations decline. San Diego's premium aspiration isn't fading because the city lost its appeal. It's collapsing under the combined weight of high expenses, surplus inventory, and a shrinking pool of purchasers willing or able to pay the valuation. Number 1. New York City, New York. For decades, New York City stood at the very summit of the global premium housing world. Penthouse apartments overlooking Central Park, classic townhouses on the Upper East Side, and sleek glass towers rising across downtown define the ultimate symbol of prosperity. But by 2026, New York City is confronting one of the most severe premium housing downturns in modern history. Premium residence valuations across the city peaked around $4.5 million in 2020. Currently, that median has dropped to roughly $3.55 million, representing a decline of about 21%. At the extreme high end, ultra-premium penthouses that previously carried $50 million price tags have been compelled to cut $10 to $15 million, and many of them are still sitting unsold. The forces driving this breakdown are overwhelming. Years of overbuilding, particularly billionaire-focused condominium towers, collided with crushing assessments and persistently rising expenses. Property assessments on a $10 million condominium can reach $200,000 per year. Monthly HOA charges routinely exceed $5,000. Insurance rates continue to climb, and mortgage obligations on $20 million properties have reached thresholds that even the ultra-wealthy are questioning. Simultaneously, demand has dried up. Wall Street bonuses have shrunk, international purchasers have retreated, and remote employment has weakened Manhattan's long-standing gravitational pull. Inventory in the ultra-premium segment has ballooned to nearly 14 months of supply, a staggering figure for a market once defined by scarcity. Rental revenue isn't providing a safety mechanism. High-end rents have softened, vacancy percentages are rising, and entire premium towers are sitting partially vacant. Investors are quietly liquidating properties at losses, and foreclosures are beginning to creep into Manhattan's premium sector, something that was once considered unthinkable. The skyline that previously symbolized limitless demand now tells a different narrative, with darkened glass towers standing as reminders of excess. New York City's premium breakdown isn't just a routine correction. It represents a generational destruction of prosperity at the very summit. From Dallas to New York, from Miami to San Francisco, the premium housing aspiration is unraveling nationwide. Valuation reductions, rising foreclosures, and disappearing purchasers are sweeping through America's wealthiest markets. The long-standing conviction that premium real estate was immune to breakdown has been completely shattered. This downturn may be even more significant than 2008 because this time the damage isn't centered on Middle America, it's hitting the very summit. If even these elite markets can fall apart, the question becomes unavoidable. Who's next? This is Stable World. If this breakdown gave you a clearer picture of what's really happening, hit subscribe so you don't miss what comes next. Smash that like button if you value data-driven analysis over surface-level coverage. And drop a comment letting us know, are you seeing luxury housing collapse in your area, or is your market still holding strong? The housing transformation is just beginning, and we will be tracking every development as it unfolds.